Welcome back to this edition of the Innovative Accountant Podcast. I'm your host, Tim Coakwell, and we have a really special episode for you today. Joining us from Toronto, Ontario is Melanie Russell with CPAC Valuations. Thanks for joining us, Melanie.
Thanks, Tim. Thanks for having me.
Yeah, it's great to have you on our show. We've got an exciting topic for our audience today. We're going to be digging into business valuation, succession planning. We've got a lot of great topics that we're going to touch on, from business owners. When should they be getting valuations? What's involved in a valuation? What are the costs? What level of reliance can a business owner or potential buyer have on a valuation? What are the important valuations issues in succession planning? How is COVID impacting all of this? So we've got a lot of great discussions that we're going to have. Melanie, our audience, probably many of them know you as we're speaking to our accounting community. But I want to just give a brief introduction of your background. You've had an amazing career, and we're very excited to have you on our podcast. So obviously started your career as an accountant. You worked with PwC for a number of years, where I think you obtained your CA designation.
Mm-hmm.
Worked
Correct.
with KPMG and PwC in senior roles over the years, where I believe you started learning about business valuations and starting your career in corporate advisory.
Correct.
You founded CPAC Valuations in 1996 in Toronto, which has grown to become a leading boutique provider of independent business valuations, dispute support, tax dispute, transaction advisory services to your clients. Your firm has been involved in valuations and other engagements for clients ranging from small owner-managed businesses to large public corporations with multi-billion-dollar market caps. That's quite a set of accomplishments there. More designations than I can count. Your business card's getting pretty full these days. So your CA, your CBV. I even think somebody told me you had the second highest mark in Canada on your CBV, which is pretty impressive.
Thank you.
You've got your CIM, Certified Investment Manager designation on the investment side. You're a certified fraud examiner, certified in financial forensics, and that's just a few of them that are on the list. So you've obviously spent a career learning and educating yourself. Not only that, you're a knowledge leader in the community, giving back through your role as president of the GTA Accountants and Finance Network, where accountants and financial professionals share their knowledge and experience with their peers. And because of your extensive professional training and experience, you're sought after and very active in teaching business valuations and related topics at various universities, professional organizations, and you also are involved in running the premier preparatory course program for CBV students, in Canada that are taking their national membership qualification exam. Many accomplishments, Melanie. I'm very impressed with and followed your career for quite some time. But let's go back to the beginning. So you grew up in Manitoba. You're in Toronto today. Tell us a little bit about your family background.
Yeah, so grew up in Winnipeg, dealing with the lovely weather in Winnipeg, and went to university there, started as a summer student in PwC, went back after the last year, and then wrote my exam there and decided to look around, and just ended up in Toronto, and joined what became KPMG when I came to Toronto.
And your accounting roots with that, what was the driver? I've come from an accounting background. We've had a lot of guests on this podcast that started their careers in accounting. I'm always very interested in what led you down the accounting path. Why did you start in business? What was the draw for that for you?
That's a great question. I guess I have to go back to university for that. And during university, I thought, well, I'll take some typing courses and other secretarial courses because my mother was a secretary. And then I ended up taking a bookkeeping course. And I thought, this is kind of cool. And I had a computer course. It was kind of cool. So without having any idea what else to do, I thought, I'll try this accounting thing. And ended up just being sort of something that kind of fit in. It was very interesting in terms of all the different aspects. And then, as most people go through their CPA now, you kind of realize there are many opportunities. Mm-hmm. So until you get that CPA, you don't know what else is out there. But once you get that, you start to realize there are a lot of opportunities. So after getting the CA at that time, it was, well, let's explore. This audit stuff was very nice, great learning experience. but let's see what else there is out there.
And so corporate advisory, and obviously you were talking to people within the firms at probably PwC or KPMG at the time. What drew you to the corporate advisory side? What was the interest there?
Well, I looked at, within the great thing about big firms, just like big corporations, there's usually lots of different places to go. So when I was trying to figure out what I wanted to do when I grow up, after getting my CA exam, passing it, I realized that, there's a bunch of different opportunities, but I kind of focused in on maybe tax and then maybe this other area, that specialized areas. So I looked at tax, and I spent some time in the tax group as during busy season, realized maybe this isn't quite what I want to do, and then researched and ultimately went into the financial advisory group and one of the firms. And what was great about that is you're exposed to various aspects. So there was the corporate finance, there was the valuation, there was the forensic, there was the insolvency. So you kind of go around and you can get a sampling of a lot of different types of work. So very, very good exposure for sure.
Yeah. Well, that's exciting. I went through a similar path in my career, going out of audit into tax, but I chose tax, and now I'm more on the advisory side. I that big green thick book, although it's exciting at times, I think the choice you made is maybe opened up some other avenues for you. So that's pretty exciting.
Well, our handbook, I'll just tell you, our handbook right now is about this thick, and half of that, or more than half of that, is in French. So that's quite a big difference, right?
Yes.
We're sort of moving towards more standards, but we certainly don't have the Tax Act or the handbook or IFRS level of coverage.
There's no shortage of reading to do in this business for sure. And as you stepped out, so you worked within the firms for a number of years, built up your knowledge within the corporate advisory side. What was the trigger for you to start Kalex? I think you said you'd started that in around 1996.
Right.
What was the driver behind that for you to go out on your own?
Well, I had went out for a stint in industry for a bit, and then came back to the firms and really enjoyed the intellectual piece at firms. Like, it really is you learn so much at firms, whether they're big or small. And then I think it was really with the second child, I decided it wasn't that I wanted to work less than 150% of full time. It's just wanting a little bit more flexibility. And even at that time, well before COVID, and still wasn't quite the flexibility. So originally I went out thinking that what I'll do is just do a lot of teaching. And as long as I have enough to pay the mortgage, maybe that's a little bit easier on the family. And then very shortly realized, teaching's a nice sideline, but you learn, I like being in the thick of things and doing real work. So quickly fell into practice slowly, and then set up my own practice.
That's really interesting. You've done a lot of teaching, obviously, with being involved in the GTA network, and I think you founded that or president of that. So that's been a really core piece since you started. I didn't realize that. So who were you teaching to when you sort of left the national firms?
I was teaching at a few universities part-time, and I did some teaching for CPA, a provincial group, primarily at that time Institute of Chartered Accountants of Ontario, that's now CPA Ontario, CPACanada, and I was doing some UV prep work and School of Accountancy work. So pretty broad base of accounting and finance education at the time.
And then obviously moved into more of the public practice service side of that. What was that like when you first got started? You were attracting some clients. Was it just yourself? Did you have some other people that you started the business with, or did you kind of start it all on your own?
Yeah, great question. Actually, how I really started was I knew nothing about being entrepreneurial. I came from the big firms, and I thought the world began and ended at the big firms, and I knew nothing about what else was out there. So when I went on and started to teach, then people would call me and say, "Oh, I heard you're on your own, can you do some subcontracting work for me? It's like, okay. And so I learned, the smaller, dealing with smaller mid-sized clients as opposed to what I was dealing with at the bigger firms. So it was so I did a lot of that, and then finally just ended up saying, okay, people were calling me directly somehow to do files, and so it just ended up starting my own. So it was definitely me at the first, and to think about having to do the work, hire employees, manage payroll, manage our own tax returns, and everything else. I thought that who can do that? How is that even possible? So didn't even anticipate getting additional people, and then realizing that you can be a sole person if you want, a sole professional, but it's much better if you can train people. And although it may be a slow process, it can be very, very helpful. And you're also giving back, training someone based on what you know.
Yeah, for sure. So yeah, not having to be chief cook and bottle washer in your company, and being able to
Right.
add some depth to that. I mean, you've built a very impressive firm. I go back to my mid-size accounting firm days, and we had corporate advisory teams, and it's always a challenge to find trained and talented people in these organizations. There's, the nationals do a great job of building that talent, but they're hard to attract, especially if you're a smaller business and you're trying to get going. You need entrepreneurial people that are willing to invest and do that. And so I'm really interested in your story and how you built your team and what you sort of attribute to that success.
That's certainly one of the most challenging things. I think one of the most challenging things of running your own practice is the people, attracting people, retaining, managing them, managing expectations, and especially when you come out of big firms, because they attract, the big firms attract the stars, the superstars, and coming out of that environment where that's just everybody's a superstar pretty well. So it's a little bit different of a mindset. Doesn't mean there aren't great people out there that don't really fit the mold of a big firm or aren't comfortable in a big firm. But it's very challenging. One of the ways, just funny enough, because I've been doing education with accountants and training for CPVs for a number of years, I've managed to meet a lot of good students, quality students, through that educational avenues.
So that opened up some doors to attract some team and kind of get going. So when your services have really become quite comprehensive, like starting off as a niche, that's one thing to maybe be doing valuations, but you're doing so much more than that today. Talk a little bit about the services your company provides and the team that sort of complements, because like you say, trying to do it all, that's a challenge, but you've obviously built up some team with some unique skill sets as well. So just share a little bit of that with us.
Sure. And I think starting at a big firm, when you get exposure to a bunch of different engagements, you kind of realize different types of engagements. But often when you start off on your own doing anything, you don't necessarily someone doesn't necessarily think you have that capability of doing everything. So it's often, I find, a case of you do one file and you become an expert. And then all of a sudden you've done so many different files, you go, I'm an expert at a whole bunch of things. How did that happen?
Right.
So I think so the kind of areas we're in are, I guess we can categorize it as planning type, execution, and then fallout, and then dispute or fallout. So we do a lot of work where it may be planning, like for succession planning or employee share ownership plans or tax planning, estate planning, planning for general sale, planning to go private if it's a public company, or planning for some kind of transaction, and then getting into that middle of it where you're actually doing the work, whatever the work is. And then we do a lot on the fallout, whether it's from shareholder disputes, partnership disputes, family law disputes, damages work, tax disputes, estate disputes, even out of deals like disputes coming out of working capital issues on a transaction. So I'd say we kind of across the gambit of all the way through.
Yeah, no, that's very comprehensive and very impressive in being able to support clients that way. And from small to large, like what's the landscape look like in your business? Are there, yes, the national firms sort of compete in that public space, those large companies. What's that smaller owner managed market like? Like being able to access firms like yourself and get the support they need, is that being served, underserved? Is there much competition at that level?
Yeah, I'd say there's a lot of competition at every level,
Okay.
and you see the big firms over time have kind of said they go back and forth and say, oh, maybe we should go through these to the smaller mid-sized companies because they'll grow one day. To saying no, we only want to focus on the higher level fee engagements. So I think in terms of competition, there's probably a lot of competition overall, but I've seen clients both we have public company clients, and we have some public company clients, but we also have a lot of private clients, of course. And some I've seen situations where the firms need the brand name, and then others where they don't need the brand name and they're happy to have someone who has the expertise, has maybe pays a little more attention to them. Sometimes it's hopefully more cost effective, maybe not. But so I think there's certainly a good broad base of possibilities out there, provided you can provide good service at a reasonable price.
Mm-hmm. Well, and you talk about brand names. Obviously, your brand is building, and you've done an excellent job of that. What do you feel makes your firm unique? When if you're being compared or you're competing on a file against, say, a national firm, what's your guys' advantage?
Well, I guess it would be, if someone doesn't need the real brand name, and then a big firm insurance policy,
Right.
as some of them do, then it's probably faster service and a little more attentive, and you're probably going to get someone who is more knowledgeable than, unless you're a huge file going to a big firm. They don't have the resources. They're not going to have the resources to put on a medium-sized file the same level of talent and
Right.
expertise.
That makes sense. Yeah. Well, I want to segue in a moment here, Melanie, to the valuation discussion. Before I do that, I'm always curious. You do so many different things. What do you love the most about what you do? What is,
That I
yeah, the type
that
of
I can
work you
do
do?
every
Sorry?
Yeah, that I can do everything.
Okay.
That's
Okay.
or anything I want in general, which is nice. And I do love the educational side and the keeping myself current. I've always thought that the best way to learn a subject is to have to teach it yourself.
Right.
And I've had situations where you're learning a week before, and then you stand up and you sound like you know something, and you go, geez, a week ago I didn't understand this stuff, now I do. So I like that aspect. I like the being able to give back and doing the training, but I also enjoy doing the different projects when you're helping out a client. I guess a client who really needs your services, right?
Yeah.
And maybe that was a bit of an issue with audit for me, although it was a great learning experience because you learn different companies and industries and different pain points and different, again, learn how to organize files and organize your thoughts. But when you feel like you've actually helped someone out, that I found was very rewarding, as opposed to, yeah, okay, now they can sign off the audit report. They had to do it. They didn't really want to see you again this year, but you're there. But here, if you get a report done and you meet a deadline, say for court, or you help do a creative solution for their issue, or help to get a good shareholders agreement together, that can be very rewarding. Whether or not the client thanks you, because often after disputes, they may not thank you, but
Yeah.
if you've done a good job, you feel good about it.
Oh, that's fantastic. And clearly you've given a lot back to your clients as well as to professionals with the teaching that you've done. It's been helpful on the Canadian side. So let's shift gears a little bit. We'll talk about valuations and get into that a little bit. My view and what I've learned over the years is that If you're not building a business for sale, you're probably not building the best business that you can. So obviously, as part of that, how you're measuring that is value, and what are you sort of creating? Would you sort of agree with that statement? How do you
I
look at it?
completely agree. I actually was just speaking to a friend, contact of mine, who is interested in selling, or is looking forward and interested in selling her accounting practice. And she's trying to think about when she does it and when she kind of pulls the trigger and how she does it. Um, so one of the comments she made is, I haven't really, I'm trying to think about whether I need to prepare the business for the firm for sale, or I should pull the trigger, because I know I don't go out and I've never marketed. I just wait for referrals, and I'm a little short staffed, and I'm scared about getting new work that I can't finish. So she has probably run her business, to do a good job, to make sure her clients are happy, but never really, as you said, uh, not run it to build the practice.
Right. Yeah,
Or
that's
exactly. So now she's saying maybe I should.
yeah, that's it's funny how as accountants and financial advisors we're coaching clients all the time on how to do that, but sometimes we struggle with that even in our own companies, right? Like to actually look at a
Mhm.
public accounting practice as that. And I
Exactly.
think some of that's because the work comes. There's always seems to be work to do, so
Right.
sometimes those other areas are a little bit maybe not front and center.
Right. We like doing the work, and we like satisfying our clients,
Mhm.
but many of us are not marketing, and that's not really what we typically do. And we're thinking of it as a profession more so than a business,
Right.
whereas you probably should think of it as both.
Right. It has value, and how do you grow that value over time? And yeah.
Exactly.
Yeah. So, selling though isn't the only reason for understanding value. So, when should business owners consider getting a valuation? Let's talk about that. There's many reasons for that.
Sure, many, many reasons. So, I've had clients, so I'll just go from my experience.
Mhm.
So sometimes clients just need a bit of a check-in. So we started this business together, or I started it however many years ago. We don't know where we are. Have we done a good job? Is there something else we should do? So it may be just to check in. Probably in the back of their minds at some point is that we may want to sell, or do some succession planning, but right now we just want to check in, and before we go to the next step, so help to develop strategy. If you are executing an estate plan or a tax plan, then as you guys probably know, the Income Tax Act will dictate when you have to have a valuation,
Mhm.
I should say should, because I've had many clients who should have done it, and then they take their chances with
They
CRA,
roll
and
the
then
dice.
CRA
Yeah.
comes knocking on the door, and it's kind of, let's fix it up
Yeah.
now. Um, Other planning things where you're bringing in partners, shareholders, employees, but getting together a plan as to how to bring them in, and a shareholders agreement. Um, Maybe even a marriage contract or a cohab
Right.
contract, which is very similar to a shareholders agreement in theory.
Mhm.
Then, of course, if you are in the midst of a dispute situation, then you may have no choice. If it's a shareholder dispute, the Corporations Act or court will dictate when you should have to do it, or a family law matter, or the tax matters, etc. So many different, if you are actually getting to the point of thinking of selling, then it's a good idea to check out the value at that point as well.
Mhm. So, accountants that you work with, what would you say the state of the accounting profession's knowledge is in this area in terms of when they need to get a valuation done? Do you feel that they've got a good handle on that? Do you feel that sometimes they try and sort of navigate that on their own? What's your sort of take from doing this work for a long time?
I think it varies, and I'll give you an example. When different rules come out that say, if you do something, if you're involved in this. from a tax perspective, and we may find you advisor guilty or have some reason to charge you, then that usually puts the fear in accountants. I would say that it really, really depends. I think the knowledge level is certainly increasing overall. And I think part of that is because there's more training on valuations in university, for example. So there's more awareness and coming right out of university, going into practice. I think some accountants are very good at recognizing when they can do something and when they shouldn't, and kind of assessing the risk, because we are accountants are very good at assessing risk. That's kind of one of our
big skill,
key strengths.
Skill, core skill.
Exactly.
Yeah.
Exactly. But then there are accountants who may feel like they want to be everything to their clients, and they don't necessarily want to admit that they can't do everything. They may be great at certain things, but they just don't want to say, I think you should bring an evaluator or a tax specialist an international tax specialist or an insurance advisor. I want to do everything for you. So sometimes I think it's just being fearful of what the client will think. But generally, if you bring in good resources, you tend to have a better relationship with the clients and a better result. So I think, in short, it depends. Every practitioner has a bit of a different perspective on it, I think.
So it sounds like the education's getting better, at least at the early stages on this. But I also think that, accountants, they're good at math, they're good at numbers, they do the financials, they have a good sense of where it's at with the client. But I also think that they think it's just a formula and they plug it in and this is the math.
Right.
And I think, speak to that. It's not just math. There's so many other pieces that go on to come up with a value. Maybe talk to some of those other sides that isn't just about the math. Sure.
Yeah. Valuation is a big secret box, and only if you're a CBB can you find out about it. Yeah. Not true. But there are, so here's a couple of things I've sort of seen with accountants in the past. And I agree, they are a wealth of knowledge. So when I get engaged to do let's just assume it's a litigation or it's just a valuation for a tax plan or an ESOP or something, the accountants are the most amazing resource, because especially those I get very excited when the client tells me they've been with their accountant for a long time. And I go, oh, that's awesome. As opposed to the clients who churn every couple of years. And I go, not a good thing.
Yeah.
But I know that they'll be able to be first of all, they'll probably understand my language. And if you have a client that is not as sophisticated or not used to valuators or forensic accountants, they may not get it, but the accountant can be a great translator of what's going on and a great resource in terms of collecting information and talking to the client. So I think that's a great positive. I think the mentality of when accountants are doing historical financial statements and they're not in the thick of, for example, I do a lot of court work, so I'm cross-examined a lot. So I know I know what
they're going to ask
another lawyer, how they're going to cross-examine me. I know what a judge is going to think. So I think in that perspective. The accountants not so much, and the accountants are often thinking historical, and because that's the right thing to do for financial statements and tax returns, whereas a valuation is supposed to be, it's perspective, right? The gist of it's a windshield, exactly, and the gist of a valuation is that someone's going to pay based on the future. They're not going to pay based on the past. The past only potentially gives them comfort. But if something substantively has changed in the industry or the business, they're not going to pay you based on the past results.
Yeah, that makes good sense. You mentioned litigation and some of the things that can happen based off how the value is being used. Obviously, there's simple situations and there's very complex situations where it's important.
Yes.
Talk about valuation. What's involved are there different levels? My understanding is it's almost like a kind of like notice to read or compilations, audits, reviews, right? You've got similar types of levels within an evaluation. Just speak to that a little bit, and
Sure.
maybe where they fit, where the lower levels fit versus say the more comprehensive levels.
Yeah, good question. And of course, we have to call it the accounting side the compilation engagement now,
Yes,
right?
yeah, that's correct.
It's going to be hard to just switch over to that, but yes. So just a bit of a history that the valuation profession in Canada was born in 1971 when the Tax Act came out and put this term fair market value. So as I always say, a bunch of very smart accountants, CAs at that time said, this could be another line of business. So the accountants kind of took that, went into this and started this valuation profession. So not surprisingly, you've got a lot of similarities that come historically. So one of the things that kind of has come up over the years, and it was formalized, I think sometime in early 2000s, was it accountants in practice evaluators in practice, most of them who were CAs at the time, but it's now switched. There's more of a mix. Knew about the notice to readers at that time, are now compilation engagements, review engagements, and audits. So they brought out these three levels, and it was, that's what was going on in practice. But the CICBV, Canadian Institute of Chartered Business Evaluators, did not formalize that in the standards until I think it was the early 2000s, but don't quote me on that. And so the idea was there's the low level of valuation assurance, there's a medium level of valuation assurance, and there's the high level. And I used to equate them to the compilation engagement review and audit, but there's a difference though, because every one of those levels provide a conclusion on value. So regardless of whether you get me to do the high level or the low level, I'm going to conclude that based on what I've done and the assumptions,
here's the number.
Here's the number. Here's my conclusion. Whereas, review engagement is a non-opinion, and same with the compilation engagement. So in terms of when they're used, it's I think some people's practice varies, but I think and some people will tell you they always use comprehensive depending on the work they do, but
that's the high level. Right?
The high level, comprehensive, that if you want to equate it to, it's like an audit kind of idea. So that is, I would say in practice, it's not required, except occasionally you get a court order or an endorsement that says thou must use this level. I don't usually see in shareholders agreements, they're usually not sophisticated enough to specify a level. And any public company transactions or issues will always require the comprehensive, right? So it's a going private transaction, a related party transaction, that you'll automatically default to that. So some people will tell you that in practice, my practice may be 5-10% is comprehensive. Others will be more depending on the work they're doing. So it's really between the middle and the lower one. And I struggle with that because the idea of the low one was if you're just needing indication, if you just, if something might settle, why are we going to spend all this money on valuators? Why don't we just go with the lowest one? And sometimes that works, but, and for non-risky tax transactions, let's say it's just a freeze, then the calculation should, in theory, be fine, as long as it's a good calculation. But the challenge I've found over the years is that even though they tell you they don't really care what the number is, they just have to throw it on a T2057. They want to know when you come up and you say, well, here's your value. It's $3 million for your company. You stick that, get your tax person to stick that on the T2057 form. They say, oh, my business is only worth $3 million. That's it? I thought it was worth $20 million. So it's not always quite that way. So, right. And I tell people whenever there's any possible level of scrutiny coming on, don't cheap out. Just go with the middle, because the easiest point of attack when I see someone's valuation report and its calculation, first thing you say is, oh, they only did a calculation. Now, if they've done an estimate, who knows what the numbers could be? Because right in the report, right in an estimate report, well, let's say right in a calculation report, you have to say, had I done a comprehensive or an estimate, the numbers may have differed, but I can't tell you how much they would have differed. So you're telling the lawyers, you're giving them fodder right away for cross-examination.
Makes sense. So calculation, estimate, comprehensive, sounds like the majority are being done in those two first levels. What's the difference in the work that's involved in the cost? You mentioned cost earlier and how that sometimes becomes a bit of a roadblock. I know in my experience, that people tend to steer away. They, shareholder agreements, they want to push formulas in so they don't have to pay for valuations, or, you talk to clients and they're always wondering about, well, what's the cost of that? And they're concerned about that. So how, what is involved in the process, and what does that cost, even bookends, sort of feel like in most cases?
Yeah. Okay. And I'll come back to the shareholders agreement because I want to move on to that. But so just with one proviso, as it would be for accountants doing compilation engagement or review engagement or audit, the general rule is, of course, if you come across something that gives you discomfort or isn't passing the smell test, regardless of whether you've been engaged, what level you've been engaged at, you need to follow it up. And that becomes very interesting, because a lot of a big part of my practice seems to be dealing with financial information that is questionable, and you don't know it at the time until you get into it. And then you have to question whether it becomes a garbage in, garbage out. So even if someone engages us at the lowest level and we find something that's not making sense, then we have to follow it up. But the general differences are the extent of work and diligence, the extent of industry and market research, and often just the size of the report. Because the standards talk about what has to go into each level.
Right.
And you're welcome to put more in if you want, but at least you have to do this. So I'd say in general at the lower level, that in theory you're not looking at comps. But then the question becomes, of course, if there are good comps out there, are you coming up with a multiple that isn't really based in reality? So I'll just add something on the shareholders agreement.
Sure.
It's an excellent point you raised. So so when I get involved in helping out with the drafting a shareholders agreement, obviously I'm just doing the valuation clauses and the trigger clauses and things, not the lawyers dealing, and the tax people are dealing with the others, the rest of it. The options are exactly as you said. Do you want to go with a process, or do you want to go with a formula? And you're right. A lot of clients will say, I want to go with the formula because I don't want to come back to you, Melanie, every time something happens and pay you another 5, 10 or whatever, however much it costs, thousands. So if you choose a formula, I have no problem with that, but I will draft this nice report after doing a valuation of the company, turn it into some kind of big picture formula. And then in my reporting letter, I say, here's a formula. That formula may be great today, tomorrow, I don't know, maybe not. A week later, maybe not. But definitely revisit it every 2 to 3 years.
Yeah, it's tough to capture the nuances of a business in a this plus this equals this. It just doesn't, and you'd mentioned earlier the importance of understanding how the industry's changing, doing the research on multiples. And I mean, you might have a formula today based on how the economy and the market and the industry they're in is working, and that could change. You look at the impact of COVID, and we're going to come back to that in a moment.
Exactly.
But there's lots of things that'll impact that where that formula is kind of useless.
It is, but you got to start at the big picture level. So if the parties are saying, I'm willing to take the risk that I'm going to get the short end of the straw when it like
Right.
I may be the one that gets not enough, or I pay too much. If you're willing to take that risk, as opposed, you do that risk, that opportunity and versus risk assessment, then fine. But as long as you understand that formula is not going to be fair market value, it just isn't. But it may be fair enough,
Yeah, it's close
and
enough that
may
they're comfortable
close
with it,
enough,
and if it
right?
saves them some money. So obviously, smaller valuation companies, that may be more efficient to look at it that way. The larger the company gets, the larger those gaps probably could be, and
Exactly.
they can also afford to invest in the valuations. So, um,
And I'll give you a little example of that. We did one a couple of years ago where the process in the agreement was both parties, if there was a trigger event, both parties would get a valuator. And then if they were within, I think it was a 10%, you just averaged it. If you're outside of that, then the two valuators were supposed to agree on a third valuator. And if they couldn't, they go to court and they would get a third, the court would appoint a third valuator. And that third valuator would decide whether they want to pick either one, or they want it, whatever they want to do, or do their own.
right.
So this was a company that was I think it was 100 million of value. So we did those two. It was outside of the 10%, and the fees for the third valuator ended up more than us and the original valuators, and so the fees were not low at all in total. But our client was really, really happy because they ended up very close to our number, and they were more than happy to have paid those fees. Whereas, exactly as you said, small clients, they just couldn't afford the cost of three valuators.
Mm-hmm. Yeah, yeah, and on the cost side, we talked about that a little bit earlier. So, industry wise, like what can companies sort of expect as bookends on these things, like calculation, estimate, comprehensive?
Oh,
Obviously, there's a huge range in there in terms of what that feels like. On
right.
average, what does that sort of look like? Just for if there's accountants in our audience that are kind of
Right.
wondering what to expect if they're bringing a evaluator to the table.
Yeah, it's tough to say averages. So
Mm-hmm.
I'm going to qualify, and anyone can, of course, contact me and give me
Yeah.
their scenario, and I can give them
Yeah, it'd
something
be
more
much more.
qualified.
You need to customize it and understand the client for sure. I get that.
Right. So if you're talking of let's say one company, not this complicated organization chart, but one company that is fairly straightforward, not a startup company, so you're not necessarily getting into discounted cash flow or projections, um, and not huge issues, and you're you hopefully have good financial
Mm-hmm.
information, not having to deal with interim information that isn't reliable,
Right.
and we end up having to be the bookkeeper or the accountant. Maybe four to five, 46,000,
Okay.
something like that.
Yeah, that's it. That
Um,
sounds
yeah.
about what I've heard. And then on the comprehensive side, obviously that can be tens of thousands of dollars to kind of go through that type of an exercise. Just because.
Yeah, well, I usually say in general, totally in general, you can probably say that you're going to do 150 to 200% as you go up. So not necessarily double, but maybe close to
Okay,
doubling.
that's a good rule of thumb.
But of course, if you have terrible financial information, then you may put yourself out of evaluation, and you're more into the forensic piece and fixing things up, which can often cost more than evaluation.
For sure. that's that's the uh, that's the thing, right? Like it's what are you willing to invest on the front end to sort of keep things simpler on the back end? So
Exactly.
yeah.
Yeah.
So let's. I was going to jump into multiples and EBITDA. We may come back to that if
Mhm.
we have time, but I want to. We're in the midst of a pandemic. COVID's caused a lot of changes, hurt a lot of businesses, helped others.
Right.
Values have definitely been impacted, maybe even processes. How has that impacted the work you're doing with your clients?
Well, I would say it's definitely impacted, and it depends when. So I did a lot of presentations during um, during the pandemic about different times, and my comments would be totally different each time. Right at the beginning, the entire valuation world was struggling with how do we deal with the fact that there are no deals being done at that
Mm-hmm.
time. The markets just there's no liquidity. What do we do here? So at the beginning, the concept was that multiples are definitely lower, risk is higher. There's, one leading body in the US that most people follow and look at for some cost to capital guidance was saying you have to add in a 1% premium for COVID, just ballpark, because there's overall risk across the board. So it's another, got to add in a percentage. And they took that off a number, at least a year ago. I think they recommended that
Interesting.
you take that away. So I'd say the market, it also changed the valuation approach, because what we had clients who had either done a tax plan or reorganization, or were in the midst of doing it and hadn't quite signed up, and then this hit, and they said, okay, things have changed. Melanie, we need you to tell us how you think the value has changed. And if the value has gone down a lot, then we may do a different plan. If it's gone, who knows? So we ended up doing a lot of scenario analysis and saying, based on these assumptions, here's where the value may be, or these assumptions. And that they take that back and go back to their tax planners or advisors to figure out whether they needed to change the plan, refreeze, or whatever they were implementing.
Yeah,
Or I saw a lot of people. I saw a lot of people holding off on like employee plans at that point as well.
Yeah, well, so everybody's talking right now about the Great Resignation, and companies are struggling with retention and sort of how are they attracting people. How are you seeing any of the strategies changing? Are you seeing more companies embracing, whether it's phantom or equity-based compensation to try and tie people to the value of organizations longer term? What are you seeing happening today because of COVID?
Yeah, I've definitely seen that, and whether or not they're implementing it, they are certainly thinking of it, because they're trying to be creative on how do we keep our staff, because the cost of losing staff, although at the beginning of COVID, you may have been very happy to lose your staff, not so much now, because there's such a challenge retaining and finding people, and then training them. And do you train them virtually? How do you do that? So yeah, definitely a move for creative options and thinking about tying people in for a bit of a longer term period.
So it's interesting. You probably had some clients that were needing to readdress their planning, their valuations for purposes of their own ownership group, but they're likely even leveraging those now to deal with what are we going to do with our people and how do we keep them part of this. So that's interesting to see.
Definitely.
Let's switch gears a little bit. We've touched on succession planning a little bit. What does that process look like? How does your firm sort of support companies and accountants that are saying, we got a business owner here, maybe we're 5 years out, we've got to start thinking about succession planning. What does that sort of look like? Just walk us through that.
Yeah, it's a very great question. It's a very individualized process, because the first thing really is, if we get involved early on, it's sort of checking out the strategy. And sometimes we're involved to kind of do a valuation, let's say, to see whether it makes sense at this point. So someone is saying, I think 5 years from now, I really want to be out of here, but am I going to have enough to retire? So let's figure out how much you might get if you sold, and how does that translate into net after tax proceeds in your pocket. And then out of that, what are the trigger points for value? And if you change and did certain things here, what might that look like if you revisited this in 3 years, 4 years, however long, and what it might look like. So I think that the strategy is really, really important up front, and making sure that business owners understand what that means to succession plan, whether they're getting out totally or partly, because often that means um, less control and less control for someone who has built a business. And as I always say, it may be their favorite child. Is a challenging thing, and thinking about what are you going to do afterwards if you are totally out. Um, you've spent your whole life on this business. You have no hobbies. You and your spouse separated a long time ago. So what are you going to do with your time? Your kids don't speak to you, or whatever it is. Or maybe you like to travel. Oh, you can't travel that. It's hard to travel right now. So thinking of being realistic about the strategy, and then trying to time it. So we may get involved up front. We may get involved when the other advisors have already sort of decided what's happening, and then they're putting it together, and they need evaluation or quality of earnings report or something to kind of cement the plan.
Mm-hmm. That makes good sense. One of the things I've noticed over the years and working with different companies that do corporate advisor work, M&A work, often there's big fees on those transactions.
Mm-hmm.
They don't want a lot to kind of interfere with that process. And I was always confused as to, and this is why I like the phrase succession planning, because it requires you to look into the future as well, not just based on the transaction, the event. Where do you see retirement planning fitting into that? Like, I find it hard to look at a sale of a business and go, well, you're going to get X, when we don't even know if X is the right number. So
Right.
how do you sort of integrate that through succession planning with the work you do?
Exactly, and I think that's a great point. Is that real looking at what someone might get, and so if you do sell in different, and I think scenario analysis is a big.
Mm-hmm.
We do a lot of that, and everyone should. And even in the litigation work we do, courts love when you do different scenarios, because on things that are not black and white. So if something different can happen, then tell the court that if this happens, here's what it looks like. Same idea for the business owners. If this happens, here's what you might get. Now, what are you going to do with those proceeds? Is that enough for you to retire? So also having, analyzing what your the owner's lifestyle looks like after the plan. If they're going to continue to work for a bit, do they have some income coming in? Or if they're totally cut off and they're not working at all, and they've got $10 million or whatever it is on the net proceeds, what is their risk tolerance? What should they invest it in? And what will their retirement income look like?
Yeah, there's all these complex things, right? And I guess, with from my perspective, it takes a team approach. You're starting getting information from the trusted accountant that has that relationship, but very quickly, you're starting to involve shareholder agreements to document some of these things. So you've got the legal angle. You're starting to have conversations around what is that future look like post sale and post valuation of this. You need to be incorporating maybe the investment team or the financial planning people that are in that. How do you like to work with that? What's the way that you guys sort of create that integration with your clients? Do you take the lead on that? Do you sort of obviously it's probably different every time, but how do you like to work in that type of an environment?
Yeah, that's another great question. I like to think of the holistic approach and the collaborative approach. We'll certainly get a better result. And I do the amount of dispute work I do and have done. I realize how often things could have been prevented if someone had used that holistic or collaborative approach, and someone had taken the lead. And because often, you may see this happens in deals, this happens in tax planning, it happens in anything where someone comes up with a great plan, but someone isn't there to execute it,
Right.
and it falls apart. And then all of a sudden, someone realizes, oh, they forgot to do a valuation of these pref shares, and someone's trying to redeem the holders redeeming them, but we can't redeem them because we don't have the valuation. So we got to get an evaluator to do that, and then we can start redeeming it. So my personal preference is working in a team. I mean, you don't always have to have a team. Sometimes the issues are pretty discrete,
Right.
but often the best way to do something is team, and assigning someone or someone taking the lead, and they're going to be there from the beginning to the end.
Yeah. Perfect.
And we can certainly do that, but I find that the trusted advisor, whether it's the accountant or sometimes the investor, who's ever setting up the plan, is the one who's going to be there the whole time. The lawyer, probably not. The lawyer, it may be there to do the paperwork and may be gone. So often it's it may not be the evaluator, but it's probably the trusted advisor that needs to take a proactive role.
Yeah. No, that's really, I love hearing that, because I think that's the part of the professional services industry today that's just sometimes it's very fragmented, and clients don't get the full, they might get part of the plan, or it's not executed, and you end up with all these issues that kind of come from it, and not great outcomes all the time. So I would expect, with what you seeing the size of your firm, how you guys have done, and just knowing the work you're doing, that you guys are delivering a great client experience there. Last question, then I want to talk about books for a moment. So just there, lots of accounting firms, as they're growing, they tend to go from generalists to maybe they have a tax partner, and then maybe they add a corporate advisory group. For firms that are looking to increase their value, and maybe it is through corporate advisory, you've had success in that area. What advice would you give accounting firms out there that are looking to get into this area?
Well, if you're looking to grow the firm, I think the first thing is, again, have a strategy. Sometimes you see, I get involved in helping out succession planning with accounting firms or selling or whatever, and I get a lot of people say, "Oh, I want to buy this. I want to buy," and just you see companies buying for the sake of buying, but it should come from a point of strategy, and well thought out strategy, that it makes sense. So if you are thinking that you want to grow the firm, grow the services, and corporate advisory or valuations or forensic or whatever it is a good service, be realistic about whether you can support that function. Because if someone's going to come into a firm, if they don't have a book of business already, then they're going to be expect to get something from you. And my experience over the years is that if a firm is not in that area, it's a tough thing to grow. Mm-hmm. However, if you bring in someone who does have that expertise, then that's great, but you have to be willing to probably be creative on remuneration and arrangement side, because they may have come from a place where the remuneration structure is different. Mm-hmm. But sometimes you don't need, like, building a practice and bringing someone in is not necessary. You don't always have to do it. You can have some virtual arrangements where you can satisfy your client's needs much more expeditiously and cost effectively than building up a whole group.
Mm-hmm. Instead of worrying about all the retention and training and all of the pieces that go along with that.
Right.
But obviously you've had some great success with that. And have found ways to attract good people and keep them. So kudos to you. Not an easy thing to do in that business. Switching gears here to just books. You co-authored a book. You
said book, and I didn't know what kind of books you were going to talk about.
I'm going to talk about a couple of things here, but
a few books.
But yeah, so you co-authored a book, Understanding Business Valuation Reports. Talk a little bit about it. What drove you to write that? Did you enjoy the process? Are you writing more?
I'd love to write more, but it was a bit of a COVID project. So okay. My esteemed colleague, Dr. Howard Johnson, that probably everyone knows, and I worked on this project during COVID. So it was one of those things where who knows what's going to happen during COVID. Maybe maybe we will never get another file. And he does a lot of M&A advisory. So, he probably thought maybe I'm never, no, all businesses will be shut down. I'm never going to get another file. So why not write a book?
Yeah.
So it was a great experience. And, it didn't take that long in the end. It was actually surprisingly quick to come out. I am working on something else for CPACanada, which is putting out a professional advisory assistance in the area of valuation. So for practitioners who want to do valuations or regardless are going to do it, this is sort of a guide to help out.
Oh, perfect.
So we're
kind of alludes to the earlier question on how to kind of get going and doing that. That's great.
Right. Yeah. Right. But recognizing that it may not always be there. Certain things you may want to stay away from in terms of valuation, but some of them they're may be fine. But if you're going to do it, then make sure you're sort of prepared for it and understand what's involved.
Right. And so let's talk about that quickly. What is, obviously the CBV program is that where to start if you're jumping into that valuation space?
Yeah, I think if you're going to make a commitment to the valuation, like going that route, then certainly start your course of studies. Some people, depending on the state of their career or if they're already busy with their practice, may not want to invest as much time as would be involved because it's like going through another CA, UFI or CFI. So there are lots of courses out there, lots of other training you can get if you just want to get some idea of what's involved. But if you do, if you're going through and you want to get the CPV and you want to start being able to put your stamp on reports, then certainly going through the CPV program of studies is the right way to go.
Yeah, perfect. Other books. I always ask my guests, the one question I always ask my guests is other books are you reading? I was in Strategic Coach for a long time and I always appreciated hearing what others were reading and got a lot of value out of that. So yeah, what do you have on your desk?
Yeah, well, when I have time, which is of course
never
a bit of a commodity, I love those old novels, big time. But I am in the process of reading *Sapiens*.
Okay, interesting.
Definitely not a business related book at all, but very, very interesting insight into who we are as human beings and what makes us tick and what sort of historically made us tick. By Yuval Noah Harari.
Okay, cool.
Very interesting fellow.
I'm going to check it out. Thank you so much for sharing that. And
thank you.
Just before we wrap up, Melanie, I just wanted to sort of, if our audience listeners here today are maybe wanting to learn more about this or more about your firm, what's the best way, what resources can you offer to them, and what's the best way maybe to get a hold of you or your firm?
So you can always check out our website, kalexvaluations.com, KALEXVALUATIONS.com. And you can reach me in my email at melanie@kalexvaluations.com, MELANIE. And you can also feel free to call my office, 416-488-9590, extension 225, and connect with me through LinkedIn as well. I love LinkedIn.
It's a great resource.
It's a great resource.
Maybe that might even be how you and I connected originally. So
it may have been, yes. So thank you, LinkedIn.
Yeah. So the other final comment, we didn't get a chance to talk much about your GTA network of accountants, your finance network. Mm-hmm. Obviously, we're out west here. A lot of our listeners, we're expanding hopefully across the country as we continue to do this. But if they're interested in being part of that network or joining or learning more about what you do there, how do they go about doing that?
Sure, you can just check out the website. So the way that program works is we offer a bunch of different speakers on various topics, both technical and non-technical, and technical being a broad variety of areas, including we had a family law session, we had decision making, and a tax session this week. So we have a lot of content. So you can feel free to check out gtaccountantsnetwork.com, and there's sort of live upcoming webinars, and then everything we do is posted on demand. And we really try to focus on getting wonderful speakers. I believe Tim is going to be one of them shortly. So wonderful speakers on excellent topics and at a cost-effective means.
It's a great resource. You guys have done an amazing job of bringing good speakers together and great content on a regular basis, which is tough to do. So that's likely a full-time job for you, let alone everything else that you're doing. But
or for someone else.
Yeah, there you go. You're good at delegating. That's what you need to do. Anyways, well, thank you so much, Melanie, for your time today. I really appreciate you taking the time out of your busy schedule to share it with us and share your experience. Built a great firm, great resource. I'd encourage all of our community to reach out to Melanie, get to know her a little bit and her team. I'm sure there's ways that you can collaborate and she can give you a hand with either your business or your clients. So on that note, thank you, Melanie.
Thanks so much, Tim. It was a pleasure.
Yeah.
And thanks for listening, everyone.
Yeah. And that ends this edition of the Innovative Accountant Podcast. Thank you for listening. I hope you enjoyed our time together.